Greetings everyone. In this video, we are going to talk about debit and credit accounts in the balance sheet statement. What is a balance sheet? There's a very simple definition of balance sheet, and it's my favorite one. It's a sheet of balances at any given time. Now, which accounts do we list in the balance sheet? Any account which is not an expense or income. A very simple answer, because income and expenses belong to profit and loss account. The accounts which are listed in balance sheet are mainly classified into four categories: assets, liabilities, provisions, and equity. Debit accounts in the balance sheet are assets, and they appear on the left side of the balance sheet. On the right side, credit accounts in the balance sheet are liabilities, provisions, and equity. Let's talk about debit accounts in balance sheets, which are assets. Asset is an item that you bought for your business, and it is going to provide you future economic benefit. Future economic benefit is an important term to remember. It means that the item you have bought is going to be in use for more than 12 months, and it is going to help you in earning money for your business. It could simply be a computer that you are going to use in your office, or it could be a phone that is going to be used for making calls to your customers or your suppliers, or it could be a plant and machinery item, or it could be a building that you are going to rent out and earn rent from it. Normally, the assets would be over a certain amount for it to be material enough to be classified as an asset. Let's talk about credit accounts in balance sheet now. These are the items which are appearing on the right side of the balance sheet. It could be a liability, it could be an equity, or it could be a provision. Liability is the amount you owe to other people. It can be your suppliers, or it could be somebody you borrowed the money from to invest in your business. What is equity? Equity is the amount you invested in your business from your own pocket. It could be retained earnings as well. Retained earnings are the profit which your business made in prior years, and you did not withdraw it from the business, so you reinvested that profit in your business. A provision is account with the credit balance which reduces the amount of an asset. This is because you believe that the asset's value is not what it is showing in the balance sheet. For example, provision for doubtful debts or bad debts. You know that out of your debts, AR, accounts receivable, in other words, is not going to be realized completely. So you provide for some amount to be written off when it comes to that. Now, this is a sample balance sheet of a very simple account. It's just a very simple format. On the left hand side, you can see there's bank, there's cash, there's AR or account receivable / debtors, there's plant and machinery, car, computer. And on the right side, there's liabilities, accounts payable or creditors, income tax due, provision for doubtful debts, equity or retained earning. The important part is that the total at the bottom of those two amount columns should be same. If it is not balancing, then there is some error in your accounts. The logic behind that is accounting is based on double entry system. So every debit has a credit, or every credit has a debit. So it should always balance at the end. Hope you enjoyed today's video. Thank you very much.